Hello students, Principles of Insurance, Lesson 5, Insurance Products. In this lesson, we study life insurance products, risk of dying early, risk of living too long, products offered, term plans, pure endowment plans, combination of plans, traditional products, features of annuities and group policies, general insurance products, features of products covering fire and allied perils, products covering marine and transit risks, products covering financial losses due to hospitalization, products covering miscellaneous risks. Life insurance product, risk of dying early, risk of living too long. Let us know about the life insurance and the risks it covers and the types of insurance products. Life insurance can be termed as an agreement between the policy owner and the insurer, where the insurer, for a consideration, agrees to pay a sum of money upon the occurrence of the insured individual's death or other event such as terminal illness, critical illness, or maturity of the policy. The life insurance sector is one of the fastest growing finance related segments in our country. There are many different products with a variety of offerings, right from fueling investment needs to meeting different financial goals. They come with many objectives for the investor. The life insurance contract embodies an agreement in which, broadly stated, the insurer undertakes to pay a stipulated sum upon the death of the insured or at some designated time to a designated beneficiary. In life insurance, insurers offer covers insurers offer covers to protect the individual against the risk of dying too early or living too long. Risk of dying too early. Each individual has got a certain financial value attached to his life in the form of his earning potential. If he or she dies at a young age or during the time when he had an earning potential, the family suffers a financial loss in the form of loss of his potential earnings. A lot of his obligations towards the family remain unfulfilled due to the sudden demise. This is called the risk of dying too early, and it can be protected against by taking life insurance coverage. Risk of living too long. Every individual plans his life and his source of income to the best of his ability, taking into account his life expectancy. Sometimes, despite the best of planning, the individual is not able to provide for contingencies such as serious or chronic or prolonged illness for himself or his spouse, which results in all the planning going haywire. If a person survives beyond his expected age, his planned source of income could diminish or become inadequate due to various reasons. This could result in his not having money at the time when he needs it most and is not in a position to go and earn because of old age. It is called as the risk of living too long and protect against the same by taking whole life insurance policies where withdrawals are possible as and when required or by taking pension policies or annuities. Life insurance covers certain other risks which are connected with the human life in addition to the risk of death. Example, in case of total and permanent disability or the living death, temporary disability and medical expenses, compulsory retirement or the economic death risks, etc., have been covered under the purview of life insurance these days. In order to regulate the sector, the IRDA issued various regulations for different types of life insurance products. Regulations stipulate the structure and broad features of different types of products with a view to ensuring protection of policyholders' interests as well as uh, for the development of the industry. A few common types of covers include whole life and term insurance products. Traditional products. Traditional insurance plans include endowment and whole life policies. They offer multiple benefits in terms of risk coverage, return, and safety. Traditional policies are considered risk free. They provide fixed return in case of death or maturity of the term. Term insurance policies. The basic objective of a term insurance policy is to secure the immediate needs of nominee or beneficiaries in the event of a sudden or unfortunate demise of the policy holder. The policy holder does not get any monetary benefit at the end of the policy term except for the tax benefits he or she can choose to avail throughout the tenure of the policy. In the event of death of the policyholder, the sum assured is paid to his or her beneficiaries. The term insurance policies are also relatively cheaper to acquire as compared to the insurance products. Money back policy. Money back policies are basically an extension of endowment plans wherein the policyholder receives a fixed amount at specific intervals throughout the duration of the policy. In the event of the unfortunate death of the policyholder, the full sum assured is paid to the beneficiaries. The terms might slightly vary from one insurance company to another. Whole life policies. A whole life insurance plan covers the insured over his life. The primary feature of this product is the validity of the policy is not defined, so the policyholder enjoys the life cover throughout his life. Pension policy. Pension policies let individuals determine a fixed stream of income after post retirement. This basically is a retirement plan investment scheme where the sum assured or the monthly pay after retirement entirely depends on the capital invested, the investment time frame, and the age at which one wishes to retire. There are again several types of pension plans that cater to different investment needs. Now it is recognized as an insurance product and being regulated by Insurance Regulatory Development Authority IRDA. Linked policies. A unit linked insurance plan is a product offered by insurance companies. Unlike a pure insurance policy, the investors both insurance and investment under a single integrated plan. It gives investors both insurance and investment under a single integrated plan. Unit linked investment policies, ULIP. This policy is a insurance cum investment category where one gets to enjoy the benefits of both insurance and investment. A part of the monthly premium payout goes towards the insurance cover. The remaining money is invested in various types of funds that invest in debt and equity instruments. ULIP plans are more or less similar in comparison to mutual funds, except for the difference that ULIPs offer the additional benefit of insurance. Term plans, term life insurance, whole life insurance. Term life insurance is designed to help people purchase the protection they need when they can't afford to purchase permanent life insurance or when they only need coverage for a specific time period. Term life has a guaranteed death benefit but no cash value, and the premium will increase at predetermined intervals such as after 1 year, 5 years, 10 years, or 20 years, depending on the kind of policy you purchase. It is very often the product of choice when protection needs may be high or a period of time, such as when your family is growing. Term life can also be an effective way to supplement permanent insurance during the high need years, such as when family and the other financial responsibilities are outpacing income. Whole life insurance. In contrast to term insurance, whole life was designed to provide life insurance coverage plus other living benefits, including guaranteed cash value accumulation as long as premiums are paid, eligibility to earn dividends, and the access to cash value via loans and partial surrenders. Whole life provides lifelong insurance protection. Once you have been approved for coverage, your policy cannot be cancelled by the carrier as long as premiums are paid when due, regardless of health of insured. The insurance will remain in force. In term life insurance, we have term death benefit, guaranteed term death benefit. In whole life also, guaranteed permanent death benefit will be given. Generally, federal income tax free death benefit. Generally, federal income tax free death benefit. In term life insurance, premiums are usually guaranteed for initial term, whereas in whole life, premiums are guaranteed to stay level for the life of the policy. Potential additional growth of policy value through dividends. In term life, insured pay for pure death benefit protection for a certain period without cash value accumulation, whereas in whole life offers tax deferred cash value growth that is accessible through policy loans or partial surrenders. In term life insurance, term conversion privileges are available with most policies, enabling you to convert to a permanent policy that builds cash value with no additional medical underwriting. Whereas in whole life, there is no such conversion is allowed. Coming to the group policies, group insurance covers a defined group of people, members of a professional association, a society, employees of an organization. Group insurance may offer life cover, health cover, other types of personal insurance. Group insurance has several advantages, among which is cover made available to members irrespective of age, gender, socio-economic background, or profession, so long as they belong to the group that is applying for insurance. Most insurance companies of India have introduced group insurance policies to meet insurance needs of specific groups, including professionals, employers, employees, cooperative societies, among others. Main types of group insurance are group life insurance and group accident and sickness insurance. The group life insurance allows the members to name the beneficiaries of their choice. The employee or member has a special privilege to convert the policy on termination from the group. Group life insurance is a simple and economic way of providing life insurance to employees. This policy generally a fixed sum is paid to the dependents of a covered employee on his death. It is also possible to offer what is known as a graded cover that offers different covers to different categories of employees within the same group. Group gratuity scheme. The group gratuity scheme is an insurance scheme covering the employer's liability to pay gratuity under the Payment of Gratuity Act 1972. The Act requires the gratuity to be paid to those employees who have served the employer continuously for at least 5 years. The amount of gratuity to be paid is the rate of 15 days' wages based on the wages laws drawn for each completed year of service. Group Superannuation Scheme. After retirement, employees need financial security. The Provident Fund and the gratuity provide the employer may not be sufficient in an inflationary economy. Superannuation scheme aims at providing old age pensions to employees after retirement. The popular schemes include on retirement of a member, the corpus contribution plus interest utilized to provide the pension as per the directions of the member. On death of the member, the pension is payable on the life of the beneficiary. Corpus is utilized towards the payment of pension of the type the beneficiary may opt, and the benefit so received is tax free. On withdrawal, the insured can get the equitable interest transferred to the superannuation scheme of the new employer or opt for immediate or deferred pension. Group insurance scheme. Employees deposit linked insurance scheme. All employees to whom the Employees Provident Fund and Miscellaneous Provisions Act 1952 applies have a statutory liability to subscribe to Employees Deposit Linked Insurance Scheme 1976 to provide the benefit of life insurance to all their employees. Under the amended scheme, which came into effect from 24th June 2000, the insurance benefit is equal to the average balance to the credit of the deceased employee in the Provident Fund during the last 12 months, provided that where such balance exceeds Rs 35,000, insurance cover would be equal to Rs 35,000 plus 25% of the amount in excess of 35,000, such subject to a maximum of 60,000. Thus, if the length of service is not adequate or the salary is low, the average balance may be substantially less, and such the benefit to the employer's family is either inadequate or non-existent. LIC's group insurance scheme has been recognized as one such scheme. The main benefit of the employee under this scheme is coverage offered by LIC scheme is higher than the offer under Employees Deposit Linked Insurance Scheme by the Provident Fund authorities. Double accident benefit can be allowed to the extent of the sum assured for an extra premium. Each employee is covered for a sum assured ranging from 5,000 to 2 lakhs depending upon the current salary and service put in from day one, irrespective of the actual balance in the Provident Fund. Alternatively, every employee or worker can be covered for a uniform sum assured, which will be decided depending upon the group size. Group Savings Linked Insurance Scheme. This scheme provides survival benefit in addition to the death benefit. The Group Savings Linked Insurance Scheme offers insurance cover together with a savings element. Under this scheme, out of the contributions received in respect of each employee, a portion is utilized for the insurance cover, and the balance known as contribution for savings is accumulated till exit at an optimal rate of interest. In case of death during service, the amount for which the member was covered at the time of death is also paid along with the accumulated savings with interest. Group Leave Encashment Scheme. As per the Companies Act 1956, According to Accounting Standard 15, it is mandatory for employers to provide the liability of leave encashment facility available to employees in the annual books of accounts. The group leave encashment scheme is designed to fund such a liability of employers, an option available to the employers in the group leave encashment scheme where the amount depends upon the leave to the credit of the employee and his salary at the time of exit. Features of annuities. Annuity is a contract that provides an income for a specified period of time. Annuity schemes are those wherein policyholders' regular contributions over a period of time accumulate to form a corpus with the insurers. The corpus is used to yield a regular income that is paid to policyholder until death, starting from the desired retirement age. Life insurance contracts in simple form are different from the annuity contracts in the sense that the insurer pays in the event of death of insured in a life insurance contract, while in an annuity contract the insurer stops paying upon the death of the insured. Annuities are of the following types: immediate, deferred, fixed, variable. An immediate annuity provides income for a guaranteed period of time. Payments begin within 1 year of purchase. Income payments can either be for life for a specified number of years or combination of both. Deferred. In the case of a deferred annuity, the payments to be the annuitant start after a certain deferment period. A deferred annuity is made with either a single purchase payment or several purchase payments over time. A deferred annuity can be converted into a stream of income at any time after 12 months. Fixed. A fixed annuity assures minimum rate of return. Variable. A variable annuity offers a variety of investment fund account portfolios, including growth-oriented portfolios that can help you keep with the inflation. Variable annuity values and income payments may vary based on the underlying performance of the selected portfolio. Options in annuity. Single life annuity. Annuitant receives income payment for the rest of his life. Single life with period certain. The annuitant receives income for the rest of his or her life. If the annuitant dies before receiving a specific number of payment, the beneficiary will receive income for the remainder of the period. Joint and survivor. The annuitant and the designated joint annuitant will receive income for the rest of their lives. Benefits of annuities: helps accumulate long-term savings, helps maximize income in retirement, provides lifetime of regular income source. Tax benefits under Section 88 of the Income Tax Act 1961 benefits the beneficiary on the death of the annuitant. General insurance products. General insurance policies products will insure anything other than the life of an individual. Technically, there are two types of insurance: life and general insurance. Any insurance policy insuring anything other than the risk to a person's life is general insurance or non-life insurance. General insurance companies of insurance of property against fire, burglary, personal insurance such as accident and health insurance, and liability insurance which covers legal liabilities. There are also other covers such as errors and omissions insurance for professionals, credit insurance, etc. Types of general insurance: fire insurance, marine, motor insurance, health insurance, agriculture and rural insurance, travel, home insurance, commercial insurance. So, fire insurance, the most popular property insurance is the standard fire insurance policy. The fire insurance policy offers protection against any unforeseen loss or damage or destruction of property due to fire or other perils covered under the policy. The different types of property that could be covered under a fire insurance policy are dwelling, offices, shops, hospitals, places of worship and their contents, industrial or manufacturing risks and contents such as machinery, plant, equipment and accessories, goods including raw material, material which is in process, semi-finished goods, finished goods, packing material, etc. Marine insurance business involves the import and export of goods within national borders and across international borders. Movement of goods is with the which has a risk. Mishaps will take place, which can result in damage, destruction of shipments. This leads to substantial financial loss for both the importers as well as the exporters. Marine cargo insurance covers goods, freight, cargo, and other interests against loss or damage during a transit by rail, road, or air. Shipments are protected from the time the goods leave the seller's warehouse till they reach the buyer's warehouse. Marine cargo insurance offers complete financial protection during transit of goods and compensates in the event of any loss suffered. The party responsible for insurance for insuring the goods is determined by the sales contract. Marine cargo insurance policy can be taken by buyers, sellers, import or export merchants, buying agents, contractors, banks, etc. The policy usually covers the cargo but can also be extended to cover the interest of a third party post transfer of ownership as determined by term of sale. Motor insurance. Motor insurance covers all damages and liability to a vehicle against various on-road and off-road emergencies. Motor insurance offers protection to vehicle owner against damage to the vehicle. It also pays for any third-party liability determined by law against the owner of the vehicle. Motor insurance is a mandatory in India as the Motor Vehicles Act 1988 and needs to be renewed every year. A comprehensive motor insurance policy would include personal accident and liability only policy in addition to own damage cover in one policy. Common on motor insurance categories include car insurance, two-wheeler insurance, commercial vehicle insurance, etc. Health insurance. Healthcare costs are increasing every year. Sedentary lifestyle and stress at work negatively alter the health and can result in critical illness or medical emergency. Such a scenario is sure to adversely affect one financially due to the massive outlay of money on medical expenditure. A health insurance policy is the only way to mitigate the financial risk. Health insurance covers the medical and surgical expenses. Health insurance often includes cashless facility at empaneled hospitals. Common types of health insurance policies include individual policy, family, surgery cover, comprehensive health insurance, etc. Agriculture and rural insurance. Agriculture in India is high susceptible to risks like drought and floods. It is necessary to protect the farmers from natural calamities and ensure their credit eligibility for the next season. For this purpose, the Government of India introduced many agricultural schemes throughout the country. The Pradhan Mantri Fasal Bima Yojana, launched by Prime Minister of India on 18 February 2016, a uniform premium of only 2% to be paid by farmers for Kharif crops and 1.5% for Rabi crops. The premium for annual commercial and horticultural crops will be 5%. The insurance scheme, unlike the previous ones, covers local calamities too, such as landslide, hailstorm, etc. Travel insurance. International travel, whether on vacation or business, can turn into a nightmare if one experiences contingencies like loss of baggage, loss of passport, delay in flight, medical emergency. Such eventualities will surely take the fun away from traveling. Travel insurance, also referred as visitor insurance, covers one against unseen medical and non-medical emergencies during overseas travel, ensuring a worry-free travel experience. Types of travel insurance: individual travel, family travel policy, student travel policy, senior citizens travel policy. Home insurance. Home is often the most treasured possession of an individual, the largest financial investments one makes in life. Safeguarding the physical structure and contents of home seems like a logical thing to do. Home insurance protects the house, the contents in it, depending on the scope of insurance policy opted. Home against natural calamities. Home insurance provides protection against risks and damages from fire, burglary, theft, flood, earthquakes, etc., covering the physical asset. Home insurance ensures that one's hand earned savings are utilized, hard earned savings are utilized to meet important needs instead of using them for rebuilding the house if some harm has to come to it. Commercial insurance. Commercial insurance encompasses solutions for all sectors of the industry arising out of business operation. Insurance solutions for automotive, aviation, construction, chemicals, foods, beverages, manufacturing, oil and gas, pharmaceuticals, power, technology, telecom, textiles, transport, logistics sectors. It covers small and medium scale enterprises, large corporations, as well as multinational companies. Common types of commercial insurance are property insurance, marine insurance, liability insurance, financial lines insurance, engineering insurance, energy insurance, employees benefit insurance, international insurance solutions, etc. Liability insurance. Liability insurance is any insurance policy that protects an individual or business from the risk that they may be sued and held legally liable for something such as malpractice, injury, or negligence. Types of liability insurance. Employer's liability and workers' compensation. It is a type of mandatory coverage for employers which protects the business against liabilities arising from injuries or the death of an employee. Product liability insurance. Businesses that manufacture products for sale in the general market. Product liability insurance protects against lawsuits arising from injury or death caused by their products. Indemnity insurance. It provides coverage to protect a business against negligent claims due to financial harm resulting from mistakes or failure to perform. Director and officer liability coverage. It is for a business that has a board of directors or officers, with the insurance covering them against liability if the company is sued, while a corporation by definition offers some amount of personal protection against liability to employees and directors. Some companies choose to provide additional protection to those key members of the executive team. An umbrella liability policy. It is a personal liability policy designed to protect against catastrophic losses. Generally, umbrella liability coverage kicks in when the liability limits of other insurance are reached. Commercial liability insurance. It is a standard commercial general liability policy that provides insurance coverage for lawsuits arising from injury to employees, public property damage caused by an employee, and injuries suffered by the negligent action of employees. The policy may cover infringement on intellectual property as contractual liability, tenant liability, and employment practices liability. The comprehensive general liability policy. It is a tailor-made for any small or large business, partnership or joint venture businesses, a corporation or association, an organization, even a newly acquired business. Insurance coverage is comprehensive general liability policy. It includes bodily injury, property damage, personal and advertising injury, medical payments, premises and operations liability. So, in this lesson, we are able to get an overall idea about the life insurance products, and we have studied the traditional products, and we have studied about linked policies, features of annuities, and group insurance, general insurance products, and with this we can conclude the lesson insurance products. Thank you.